Hey, Colin, welcome back to the podcast.
Thanks, Andrew.
It's good to have you back. It's been about a year since we've had you on to talk through both the U.S. market as well as the U.S. equity portfolio here at Moore. So why don't we jump right in? The U.S. market has, let's just say, had a strong run the past 6 months or so. So to kick things off here, I wanted you to just walk us through the factors that led to that strong performance toward the end of last year and in the first few months of 2024.
So the U.S. market has been very strong, like you alluded to, Andrew, especially in Q4 last year and Q1 this year. So between that 6-month period, the S&P returned over 23% in a half-year period. As you know, Andrew, we are bottom-up investors. So when you ask me that question, my mind immediately goes to kind of thinking about the bottom-up driver that led to the current rally or the last 6 months that we've seen. So there are really three sources of stock market return. And number one source would be earnings per share growth. Second one is multiple expansion. And third one being dividend. So roughly out of that 23%, roughly 20% of that return came from multiple expansion during this period, while roughly 1% came from dividend and the rest being earnings per share growth. So during that period, the stock multiples, the PE multiples of stocks went up from the low 20s to mid 20s. So when we think about what may impact stock multiples, really it comes down to three major factors. Number one would be the expectation of further earnings growth in the future. Another one being discount rate. And then the third one being investor sentiment. So when we look at each of those three factors, let's start with factor one, earnings per share growth going forward. If you recall, a year ago, there was a lot of consensus about, or a lot of talk about potentially seeing a hard landing in the U.S., so a more severe economic downturn. That morphed into a commentary more closer to a soft landing. And now, really more recently, we're talking about no landing, as in there might not be a recession at all. So that has helped the people's expectation or the market's expectation of earnings growth going forward. Another factor would be, until very recently, the interest rate seems to have peaked and was coming down for the 6 months period. And of course, we've all seen what has happened in the last month or so, and we're seeing some of that reversal coming back during Q2 this year so far. Lastly, investor sentiment has been mostly positive, with many believe that the worst is behind us, and then there's renewed excitement with productivity growth and things like AI and such. And if we peel back the onion one more layer, what we're noticing on a bottom-up basis is that many business and many business segments are actually flat or just slightly up. So they're doing okay, but not great. But there are a few noticeable winners, and they're up a lot. So a good example of that would be one that we see a lot in the headlines, NVIDIA. The stock price during this 6 months period has doubled, while another darling of the market, Eli Lilly, that sells some GLP-1 weight loss drugs, obesity-related drugs, is up around 50% during that period. So we're seeing some really significant winners, while a lot of companies are doing okay or decent.
Just hearing you talk through all of that, I think one question on the mind of many clients and listeners is, just given that broad-based strength in the market, are there any risks or vulnerabilities that are top of mind for you as you're managing the portfolio?
So anytime when we sense that the market, of course, we don't know exactly what the market is thinking, but we're seeing a lot of commentary of a lot of market commentator mentioning one thing, the risk is always that the opposite plays out. So if we zoom back 6 months, like I mentioned, one of the big factors that led to the current rally was the discount rate coming down. Interest rate having peaked roughly around 5% in the U.S. 10-year yields, and it went all the way down to the high threes. So at that point, there was a lot of consensus, increasing consensus or talk of the Federal Reserve potentially cutting interest rate sometime during this year. So, of course, that was a positive factor for the market rally. But the flip side could also be true when you talk about vulnerability. When a lot of people believe in one thing and we lose that probabilistic thinking, a lot of money spending behind one specific outcome, the opposite outcome comes up. That could be a significant source of risk. So a lot of the times when we think about risk management in the team, we ask ourselves, well, what are a lot of people talking about what are some of the market consensus that we hear a lot about, and how that might be not true and how that might impact our portfolio.
Now, you mentioned AI, and the market is, as you alluded to, showing a certain level of anticipation around the positive things that this may bring as it rolls out into both our personal and our business lives. When you think about AI's potential to transform various industries, what impact do you see it having on just general market dynamics, but also related investment opportunities in both the near or the long term?
There's no doubt that artificial intelligent AI has the potential to transform many industry, like what we saw with the internet did. So when we speak to many companies on our everyday research, the sense that I got is I would liken the current progress of AI as something that we saw back in the late 1990s to early 2000s with the internet. In that, I mean, a lot of businesses are using this technology a little bit. And so much like in late 90s, many big companies would have a website, but if you were to go on their websites back then, there wasn't a lot of information on it. At the same time, even during that time, there were some really heavy users of internet already. So poster child example of that would be Amazon, which has its whole business embedded on the internet. So what we're seeing today is that many businesses are using AI to do various smaller tasks. So, for example, it could be answering simple customer queries or automating certain repetitive tasks. While there are a few that are using it increasingly heavy users of artificial intelligence, and we own a few of them. And these heavy users include Microsoft, Alphabet, and Amazon. And those three companies, what makes them stand out is that they're not only using AI to improve their internal process. So, for example, Alphabet would be using AI to optimize their power consumption in their data center. They're also embedding AI into their products. So many of us would have heard recent announcement from Microsoft, their big launch of AI Copilot uh, within the Office suites of product. In fact, that is something that we're testing out here at Moore to increase our own productivity. So perhaps most excitingly, it's even the next level up between these three companies that they are building data centers. They're hosting a lot of these AI models in the cloud and providing companies and businesses and individuals that computing power that enables the innovation, enable different companies to test out different use cases for AI. So a common theme you might notice across these investments that we're making is that they all have a very profitable existing business while investing into the future, which is AI in this case. Because not trying to be cynical of the potential impact of AI, but large transformational changes happen very rarely. And it almost never plays out as most people expect. If you remember 4 years ago, RNA vaccines were all the hype, and there were a lot of talk about RNA vaccines having the potential for curing many different forms of cancer. 7 years ago, we would have been talking about blockchain and how that could supplant most of our record keeping system. A decade ago, we might be talking about drone deliveries where we would be getting deliveries almost instantaneously via drones. All those platforms have made significant progress in furthering the technology in those fronts, but it's probably taking a lot longer than what a lot of people initially expected, and the impact might not be what we initially anticipated. So that's why we have taken this approach where we're buying company that has profitable existing business, so that gives us downside protection, but also investing in the upside of potential AI disruption.
That's really great context. And another area that I think may be taking a backseat to the current AI news cycle is infrastructure spending in the US. There's been two major spending acts from Congress in recent years that have invested or earmarked over $1 trillion across several different sectors to be spent on projects in the next 5 to 10 years. From your perspective, what are the potential opportunities that may arise from something like this, whether that's for current holdings in the portfolio or potential investments in the future?
I would even broaden that theme further, Andrew, into a more general theme of big government spending. And certainly we're no stranger of that here in Canada. So the US federal government spent over $6 trillion with a T last year, which is a tremendous amount of money. So that level of spending is very stimulatory and really supports the whole economy and most businesses we own. Of course, there are some that are more directly impacted or more significantly impacted than others. So if a couple that I would highlight in our portfolio that is being supported or being beneficiary of the spending. One is Martin Marietta Materials. So they own rock quarries that sells rocks for everything from road construction to residential home building to large infrastructure projects. So much of the government spending you spoke about is geared towards infrastructure, and Martin Marietta is poised to receive a lot of that funding indirectly from the government as these roads get built, as new power plants get built, etc. Another one I would like to highlight is Carrier Global. What they do, a lot of us probably very familiar with their products. Carrier makes and sells heating and ventilation systems for homes and commercial buildings. So part of the government spending has been earmarked for energy efficient products. And so Carrier, it's benefiting from various rebates government might give for selling high efficiency heating products like heat pumps or air conditioners. So important to note is that these government spending not only provides upside to these businesses that we own, but it's actually a significant source of downside protection. So if a recession hits, as we know it will eventually, that these government programs tend to continue spending no matter what the economic cycles are. So while the private sector might be retrenching, these government money will continue to flow and provides us significant downside protection for these businesses.
And in the meantime, that spending may also, at least to some degree, play a role in the inflation story going forward. To wrap things up, Colin, I thought we could talk through a couple of the recent changes to the portfolio. There's two in particular that our listeners, I think, are likely very familiar with. On one side, you and the team have exited our holding in Intuit. So they're a provider of TurboTax and QuickBooks software that many people would be familiar with. And on the other side, you increased your holding in Nike. So just talk us through those decisions and how they fit within the broader portfolio construction process.
That's right. We recently exited Intuit, a company we own for over a decade. And it's been a great holding for us. It's been a 10-bagger for the fund. And as you allude to, this company is the maker of TurboTax and QuickBooks for accounting and tax filing. The idea actually originally came from me doing research over a decade ago at another long-term holding of ours, Paychex, and it was flagged to be a software potential up-and-coming competitor against Paychex. So Intuit is actually a very good example of our investment philosophy of work of buying wealth-creating businesses with excellent management team and holding them for the long term. So why is that? Well, wealth-creating businesses become more and more valuable over time, but you have to be willing to be patient to let that wealth creation play out and see its full impact. And this is where our long-term approach comes in. Another core part of our investment philosophy is thinking probabilistically about valuation. And this is another important reason why we were able to hold into it for so long. So periodically, stocks will get a little ahead of themselves. And instead of selling the whole position like we would if we only have one value for a stock, and if the stock price went above that, then the stock is overvalued. We're actually more flexible than that. We think probabilistically, so we think, hey, there is a significant chance that a company is worth more than what we think it is worth. Things are even better than we thought. There are positive outcomes in the future that we have not anticipated. So while we're holding into it for the past decade, there are various times where the stock prices have gone a little bit ahead of itself, and certainly we've trimmed during that time. But we're able to keep our mind flexible enough for a potentially significantly better outcome, which played out over the past decade. And in the end, when you ask about the exit, it really stems from the fact that the stock were trading in the higher end of our fair value range, and we saw a better opportunity to deploy capital elsewhere. And you allude to one just now, which is Nike that we added to. So Nike is one of those better opportunity that we're currently seeing in the market, and we redeploy some of that capital from Intuit to Nike. So most of us would know Nike as a well-known clothing brand globally. Apparel spending has been going up globally for decades now, and Nike is well positioned to continue to benefit from this trend going forward. It has a strong position and brand rooted in sports, and sports participation has also been going up globally, serving as a tailwind. The company has a savvy management that has an innovative and competitive culture. So, with all that positive attribute, at the core of it, Nike is still a consumer business. With that brings ebbs and flows that comes from consumer trends and consumption patterns. So at the same time, the company has decade-long history of navigating through different consumer trends and ebbs and flows in consumer spending. So currently, we might be hitting consumption slowdown in China for Nike, as well as there's a gap in product rollouts between launching their new generation of product and the older generation of product. And we're seeing that reflect in the stock price. And so we think that presents us a good opportunity to add to this compounder over time.
Well, Nike's certainly getting their fair share of our household budget these days with two kids playing sports. I think that's a great place to wrap up, Colin. As always, I appreciate any chance we get to chat about the portfolio. I'm sure our listeners do as well. So thanks for joining us and looking forward to the next one.
Thanks for having me, Andrew.